Hello and welcome to Star USA Training. Today is Tuesday, March 8th, and we're talking about export compliance and routed versus non-routed transactions. If you have questions during the webinar, please submit them using the software. And this session is eligible for continuing education credits from NCBF AA. So please send us an email to train@starusa.org after the webinar, and we'll get that submitted so you can get your credits. My name is Michael Easton. I am a licensed customs broker and the president and general manager of Star USA. Star USA is a trade compliance consulting advice, training, and services firm based out of Worcester, Ohio. We handle all manner of education, information, process improvement, development in anything to do with trade and international trade compliance. So if you have questions or you want some support, please feel free to send us an email to train@starusa.org. We'd be happy to have a conversation with you. Okay, so getting started, we're going to focus on first the foreign trade regulations, which provide the legal basis for what routed and non-routed transactions are and what compliance means, what terms are unique to the foreign trade regulations, and what the roles are for you, for your suppliers, for your partners, and the requirements that you have to adhere to. This is all meant to be foundational understanding. You guys know your circumstances better, so please feel free to ask us questions that pertain to your individual scenarios. The first thing I like to communicate whenever talking about export compliance are two basic principles that you need to keep in mind. The first is that exporting is a privilege, it is not a right. Those privileges come with responsibilities and there are penalties, and those privileges can be revoked. So treating your exporting practices as though you are making use of a privilege given to you is the right mentality to have. And secondly, you must be able to demonstrate your compliance. With exporting, there is always a presumption of non-compliance, and it's important that you know your role so that you can be able to adhere to the regulations and follow them correctly for your circumstances. It's wise to implement a comprehensive compliance program, and you certainly want to keep and maintain your records of your transactions and dealings for 5 years from the date of export at least. So the foreign trade regulations are captured or spelled out in Title 15 of the Code of Federal Regulations, Section 30. And this lays out basically the pattern that you have to follow. And on the right-hand side here are some of the key references that you should have as part of your awareness whenever considering the foreign trade regulations and your obligations under those regulations. I won't go into each one of these, but we'll talk about some of the main points from them. First up to understand is understanding what an export is under the foreign trade regulations. And this is defined in 15 CFR 30.1 as the sending or transporting of goods out of a country. Under the foreign trade regulations, goods are those physical items, raw materials, supplies, merchandise, products, any other item identified by the harmonized tariff system. If it can be classified under the HTS, then it's being exported, that counts under the foreign trade regulations. This definition differs from the definitions under the export administration regulations or the international traffic in arms regulations, which consider more than just physical goods. The FTR is only about physical goods. So what's not an export under the FTR? We're talking about software other than mass market software and media that's physical in nature and can be put on shelves, that sort of thing. Services and information. Those are not exports under the foreign trade regulations, and those are not in scope for the routed versus non-routed considerations that we have today. Those are in scope for the export administration regulations, the EAR and the ITAR, as well as OFAC controls. But that's not what we're talking about today. Today, we're talking about physical goods. The core role of the foreign trade regulations is to spell out the information and the methods and practices for getting the electronic export information filed so that the Bureau of Census can maintain visibility on our export statistics and export practices with various countries and with the businesses within the US that are conducting these exports. The EEI is the electronic export data as filed in the AES. And the AES is simply the automated export system. That's the electronic system where the EEI is filed. And it is currently accessible, the AES is accessed through the Automated Commercial Environment, ACE or ACE. So this is your universe when applying the foreign trade regulations. The EEI serves as a baseline for all of our export statistics. It helps inform things like international trade deficits, foreign policy, export control parameters, and many other key economic indicators. Filing of the EEI is a legal requirement, and it's codified under the foreign trade regulations, and the violations of those codes do result in penalties. So it's important to know which parties have a role to the transaction. And the three key parties for the foreign trade regulations are the USPPI, the FPPI, and the authorized agent. The PPI, that stands for principal party in interest. That replaces the term exporter of record that was deprecated in the early 2000s. So we no longer use exporter of record in the regulations. That phrase has no meaning under the law. Instead, we use USPPI, which is your United States principal party in interest. That's the person or legal entity in the United States that receives the primary benefit, monetary or otherwise, from the export transaction. Generally, your USPPI is going to be the seller or the manufacturer, but it could be an order party or a foreign entity in the US who purchases or obtains the goods for export before they leave the country. The FPPI is the counterpart to the USPPI. They are the foreign principal party in interest, and that's the party abroad who purchases the goods for export, or to whom final delivery or end use will be made. This party may also be the ultimate consignee, the one who receives the goods, but it does not have to be the ultimate consignee. Unlike the USPPI and the authorized agent, the FPPI is not a named party on the EEI filing. There is no box for the FPPI, but generally the FPPI is the buyer. And then the last party that has responsibilities under the foreign trade regulations, spelled out responsibilities, is the authorized agent. And the authorized agent is an individual or legal entity physically located in the US that has the power of attorney or written authorization from one of the PPI to act on its behalf and file the EEI. The party who authorized the agent is critical for determining whether the transaction is routed or non-routed. Knowing who has issued that authorization and on whose behalf that agent is acting, whether the USPPI or the FPPI, is an essential component of knowing whether your transactions are routed or non-routed. Generally, your authorized agent is going to be the export freight forwarder. It is not at all uncommon to have the USPPI also be the authorized agent. It can never be the FPPI because the agent has to be in the US at the time of the filing. Yeah, typically the authorized agent is going to be your freight forwarder, or in some circumstances at some businesses, it's going to be the USPPI. So when is an EEI required? The electronic export information is required to be filed for all exports, and you have to follow the one rule. The one rule states that all goods being sent from one USPPI to one consignee in one country of destination on one conveyance on the same day constitutes an EEI filing, when all those criteria are met. So whenever the value of goods is over $2,500 per Schedule B, you follow the one rule. And if you ever have a situation where you have two USPPI or two foreign consignees or two destination countries or two conveyances or 2 days, you have to file multiple EEIs. So you always want to get it down to the one rule so that you know that you're filing an EEI for each one shipment that meets this one rule criteria. Hopefully that was clear. So when are you required to file an EEI? And again, we're talking about physical goods. So these goods have to be on some sort of conveyance as a means of export. And those conveyance types are truck, rail, vessel, or air. For truck exports, you have to file the EEI 1 hour prior to arrival at the border. For rail, you have to file the EEI 2 hours prior to arrival. For vessels, ocean vessels, you have to file the EEI 24 hours prior to lading on board that vessel. That could be days before the vessel actually departs from the port. For air, it is 2 hours prior to the airplane's departure. So in truck and rail, it's prior to arrival at the border. For vessel, it's before it gets on board the ship. And for air, it's 2 hours prior to the plane leaving. EEI is required for exports via any mode of transport all shipments to foreign countries or areas from the United States, including from the 50 states and the District of Columbia, from Puerto Rico, from foreign trade zones located in the US or Puerto Rico, and from the US Virgin Islands. EEI is also required when shipping between US areas, including to Puerto Rico from the US, to the US from Puerto Rico, and to the US Virgin Islands from US or Puerto Rico. So this is, I have seen people conflate the EEI with ISF, the importer security filing on the inbound side. ISF is only required for vessel. EEI is required for all modes of transport. There are, however, some common exceptions to filing the EEI or exemptions from filing the EEI, one of which being Canada. And if we look at the common exemptions from filing, shipments with the ultimate consignee in Canada are exempt from EEI filing. We have a data sharing agreement with the Canada Border Services Agency, CBSA, in which we can obtain the standard EEI information through data sharing agreements. So with Canada, you do not need to file the EEI. If your commodities are valued under $2,500 per Schedule B, then an EEI is not required. If you are shipping tools of trade in their containers, EEI is not required. Trailers, certain types of racks and packaging would not require an EEI filing. And shipments from one point in Canada or Mexico to another point in the same country by routes through the US. So if it routes through the US temporarily as it's being shipped elsewhere within that same country, this would not count. Does not count shipments from Canada through the US to Mexico. There are special filings for that. But those are exempt from EEI filing. However, there are exemptions to the exemptions, or there are exceptions to the exemptions. Under an EEI must be filed regardless of its value, regardless of its ultimate destination being in Canada, regardless of its type of commodity that it is. If it's a licensable shipment under, for example, the BIS, the EAR, the DDTC, ITAR, DEA, Nuclear Regulatory Commission, if there is a license for this shipment, then you must file the EEI regardless of value if it's a $3 shipment. If it is subject to the ITAR, the International Traffic in Arms regulations, but it's exempt from a license requirement, so you have a license exception, then you still must file the EEI, even though a license is not required. And if you are exporting rough diamonds or self-propelled vehicles, those all constitute required types of products where an EEI must be filed. Okay, so the key takeaways in this universe that I want you guys all to understand, there are 3 primary parties to every transaction as far as the foreign trade regulations are concerned. Those are your USPPI, your FPPI, and your authorized agent. Each one of them has responsibilities in an export transaction. Those responsibilities differ when we're talking about a routed or a non-routed transaction, which we'll get into in a moment, but those are the 3 parties that we'll be focusing on and the responsibilities that they have under the foreign trade regulations. There are many other parties that are party to the export, but those parties do not have a responsibility under the FTR. EEI is required when you have $2,500 per Schedule B, goods leave the country by any mode, the one rule is met, and no exemptions apply. And before we hit the next section, we'll hit some questions. I commonly see questions on Schedule B. So if I have many different items in my shipment and none are over $2,500 per Schedule B, but the total shipment is over $2,500, is an EEI required? And the answer to that is no. The rule states that per Schedule B number, the shipment must be over $2,500. If you've got 5 items on there that are different Schedule Bs that are each below that $2,500 threshold, then you do not need to file an EEI. For special merchandise question, one we see commonly is what is considered a self-propelled vehicle? And the rules for getting clearance to export a self-propelled vehicle are pretty strict, and you have to contact the border to get approval. And this includes things more than just automobiles. It includes forklifts and some pallet jacks, golf carts. Basically anything with a motor and wheels is going to be considered a self-propelled vehicle, and you must contact customs prior to attempting to export your goods. And this is well in advance of the goods arriving at the border. You have to follow those special rules for self-propelled vehicles. And I have a question here about what if goods are collected from 2 different origins? same USPPI, but goods are collected from two different plants, but will be consolidated at a forwarder and will be traveling under the same House Airway Bill. So when it says one USPPI on the one rule, it's talking about where the goods begin their journey for export, and the consolidation point is going to be where the goods began their journey for export. That would likely be your state of origin as well on the EEI filing. So the goods leave from the plants, get consolidated at a specific point somewhere else, usually a forwarder's warehouse. That's going to be your point of origin where the goods begin their journey. And that's why you can use the one rule to include both of those sets of goods in one EEI filing. Okay, we will be providing a copy of the slides as well as recording the webinar to everyone after this session, so you will all have access to that. And yes, the acronyms are extremely confusing. You would say file EEI. You would file the electronic export information, or some people do say file an AES. I would consider that to be incorrect grammar. You would not file an automated export system, but people do say file the AES. People will not say file the ACE or the ACE. That's the automated commercial environment, which is a different thing. It's just where the AES lives. So you file the EEI through the AES, which is in ACE. And my apologies to everyone out there. Okay, so now now that we understand a little bit about the foreign trade regulations, we're going to unpack the routed versus non-routed and try to demystify when we have a routed transaction versus when we have a non-routed, and what our responsibilities are, generally as the USPPI in those transactions. We'll be looking at some definitions, some of the responsibilities and the requirements. So I like to begin with defining routed transactions. And I like that because routed transactions are explicitly defined in 15 CFR section 30.3E as a transaction in which the foreign principal party in interest authorizes a U.S. agent to facilitate the export of items and to prepare and file the EEI. There are two definitions in here that are of import. The FPPI has authorized the U.S. agent to A, facilitate export of items, and B, prepare and file the EEI. So those two criteria have to be met in order to have a routed transaction. This is explicitly defined in the FTR. The FPPI has therefore assumed the responsibility for filing and must authorize the agent. The routed transactions are very loosely aligned with the FCA and definitely aligned with the Ex-Works Incoterms rules, but there are some caveats to that, which I'll talk about in a second. Okay, so that's our routed transaction. Our non-routed transaction is not explicitly defined and is therefore any transaction which does not meet the definition of a routed transaction. These are also referred to as a standard transaction. So non-routed transactions do not have a definition in the foreign trade regulations explicitly. Therefore, the assumption is that anything that is not routed is therefore non-routed. That's standard. In a non-routed transaction, the USPPI has assumed the responsibility for filing the EEI, and the USPPI may self-file. They may do the filings themselves, or they can use an authorized agent. These are very loosely aligned with the C&D Incoterms rules. When it comes to using or applying Incoterms rules to routed and non-routed transactions, I'm providing this as a kind of a reference only. There was a much debate over whether FCA is routed or not. Ex-Works generally there isn't much conversation. I will tell you that the government does not recognize the Incoterms as having any relationship whatsoever to routed or non-routed. And if you do not meet the definitions of routed, you are therefore non-routed, regardless of what Incoterms apply. You can have an Ex-Works transaction, but if the FPPI has not authorized the agent to prepare and file the EEI, then you do not have a routed transaction, despite the fact that the Incoterms would seem to indicate such. Your actual actions did not back that up. The US government typically refuses to answer any questions when it comes to Incoterms-based framing. So you would need to ensure that you're meeting the criteria as defined under the regs. So under a routed transaction, There are some critical roles and responsibilities. Again, circling back to the three identified parties that we had talked about initially. 30.1 defines a routed transaction in which the FPPI authorized the U.S. agent to facilitate export of items and to prepare and file the EEI. So in a routed transaction, the U.S. PPI may act as or perform as an authorized agent, or they would be providing the FPPI's agent with data elements defined in 30.3E, 1 through 12, or 1I through 1 through 12. USPPI also has record-keeping responsibilities. So in a routed transaction, the authorized agent can be the USPPI. It is much more common, however, for the USPPI to be providing the FPPI's agent with those specific data elements defined in 30.3E1. In a routed transaction, the FPPI is responsible for authorizing the agent. So they have that responsibility of providing that written authorization, whether as a power of attorney or some other form that states that that agent is authorized to prepare and file the EEI on behalf of the FPPI. The authorized agent is therefore responsible for receiving and retaining that authorization from the FPPI. The authorized agent is responsible for filing the EEI. They also have responsibility for providing evidence of the filing to the USPPI, and they have record-keeping responsibilities as well. When it comes to providing evidence of filing to the USPPI, the authorized agent is not obligated to provide the AES record. They are obligated to provide confirmation of the data that they filed that was provided to them by the USPPI. I know I'm using a lot of acronyms. I apologize, but the gist here is the authorized agent is acting on behalf of the authorizations given to them by the foreign principal party in interest. Hopefully that was clear. And we're going to move into the non-routed transactions. Since these are not explicitly defined, it does include any transaction which does not meet the definition of a routed. And in a non-routed transaction, the USPPI has the responsibilities of authorizing an agent or self-filing. They have the responsibility to provide the agent with accurate and timely info. They must adhere to all filing requirements defined in 30.6, and they have record-keeping responsibilities. In a non-routed transaction, the FPPI has no explicit responsibilities under the foreign trade regulations. The authorized agent, meanwhile, has very similar responsibilities: receive and retain the authorization, file the EEI, and provide evidence of filing to the USPPI, as well as record-keeping. The evidence of filing that the authorized agent can provide in this circumstance is an actual copy of the AES record, the actual record of the filing itself, including all the information associated with it within that universe. A little bit more on the authorized agents. Again, they are authorized by the USPPI in a non-routed transaction, or they are authorized by the FPPI in a routed transaction. They must be physically located in the US at the time of filing. You may not use a foreign broker. I've seen this attempt to be made in Mexico, where on the Mexican side of the border, they have their broker file the EEI. That's not allowed. They must be physically in the US at the time of filing. Agents have the responsibility for obtaining a power of attorney or written authorization from one of the principal parties in interest to file the information on that party's behalf. That written authorization should specify the responsibilities with particularity. That means clarifying what they're filing and what information they're based on, what scope of filing they're allowed to do, if it's one transaction or multiple, things like that. In a routed transaction, the USPPI would not provide the agent with a power of attorney or written authorization. Again, it's a routed transaction. That's the FPPI's responsibility. The USPPI would not give the authorization in a routed transaction. So the data element types that are part of what's being filed, there are three basic categories. We have our mandatory, we have our conditional, and we have our optional. Mandatory is, in all cases, we need to identify who is sending it, who and where is it going, or who is it going to and where is it going, how and when is it going to get there, and what is the cargo. Conditional elements, these are as the case may be. If there are other parties involved, including certain agents or intermediate consignees, If there is export control information that is part and parcel to this shipment, including ECCNs, licensing details, or other departmental requirements, or if it's a special export, if it's coming from a foreign trade zone, or if it's diamonds or self-propelled vehicles. And then there are optional data elements, which are as the principal parties in interest may require. These can include things like seal numbers and equipment numbers. Data elements for routed and non-routed transactions. In a routed transaction, the data elements that a USPPI would provide are on the left-hand side. So routed transactions, USPPIs provide your name and address, provide your employee identification number, your tax ID number, the state of origin where the goods begin their journey for export, the foreign trade zone, if it applies, commercial descriptions, domestic or foreign indicators, Schedule B or HTSUS, quantity, unit of measure of value, ECCN, licensing information, and information known to affect licensing. On a routed transaction, that's what a USPPI is responsible for providing to the agent who is doing the filing. Again, in a routed transaction, the agent works for the foreign principal party interest, the foreign buyer. In a non-routed transaction, the USPPI is responsible for the 48 items that are listed on the right-hand side. This is a loose 48. It's those same 12 elements from the first part, but also all of these other pieces, including the date of the export, who the ultimate consignee is, the country of the ultimate destination. These are things that the exporter is going to know, and in a non-routed transaction, that exporter that would know these things is the USPPI. So there's a higher burden of knowing what's going on with your shipment in a non-routed transaction. Okay, so which of the following are non-routed transactions? In scenario one, in this case, you are a US manufacturer. A company in Singapore wants to buy your product, and you agree to deliver the product to their door, and you're going to call your freight forwarder and make the arrangements. Is that a non-routed transaction? Is that a standard transaction? And the answer to that is yes, that is a non-routed transaction as a standard. You are the one that is receiving the primary benefits, so you're USPPI. You are the one that is causing the export to occur, and you're making the arrangements with your freight forwarder that you have authorized. Scenario two, you're the manufacturer. The company in Singapore wants to buy your products. You agree to work with their freight forwarder to deliver the product to their door. So in this case, we are working with the foreign principal party and interest freight forwarder. This becomes a routed transaction. This is not non-routed. This is not standard because we are working with their forwarder, who is presumably authorized by the FPPI. Okay, so in our third scenario, you're a US distributor. A company in Mexico wants to buy your product, and you agree to deliver the product to the buyer's freight forwarder in Laredo, Texas. In this case, we are also a routed transaction. This is not a standard transaction because we are not the ones that are responsible for the actual exportation of the goods. That's going to be done by the buyer's freight forwarder in Laredo, Texas at the buyer's discretion, the FPPI's discretion. So hopefully these scenarios help either tie in with your situation so you can ask questions or build off of these. Hopefully illustrate the differences between the routed and non-routed transactions. One of the key concerns that we see people facing is the shipper's letter of instruction, the SLI. It is another acronym that I'm introducing, but it's very common for forwarders to request the USPPI to complete an SLI. And that shipper's letter of instruction contains a lot of boxes that you're supposed to fill in. The SLI is meant to provide information to the authorized agent that is sufficient for them to complete and file the EEI. Most companies do not provide all the necessary data elements on their standard commercial documents, like their commercial invoice or on packing lists. So the forwarders have developed a consistent form and format to ensure that all the info that they need to file the EEI is contained in one place, and they created the SLI as an answer to that. But the SLI is not a regulatory form, and it has no regulatory imperative for you to complete it. It does contain information of a regulatory nature that is necessary for filing. So you need to kind of balance what your responsibilities are, and you are going to be responsible for what information you provide them on this document if you choose to give them this SLI document. What you want to do is be careful of language like, I hereby authorize this forwarder to act as my agent and to prepare and file the electronic information. If you sign a document that is providing that authorization, that's your written authorization, the shipment may no longer be a routed transaction. If the USPPI is providing the authorization, that is a non-routed transaction. So whenever your customer's forwarder comes to you in particular and asks you to fill out an SLI, you need to be careful of what information you are signing and what the wording is, and also recognizing that you're only obligated to provide the information from those 12 data elements that we talked about earlier. So if you're being approached by your customer's forwarder to complete an SLI, you only need to complete the 12 data elements that are required for all USPPIs to provide to the authorized agent in a routed transaction. And you should not sign anything that says, I hereby authorize this forwarder to act as my agent and to prepare and file the EEI. So key takeaways from this section that I want you to kind of focus on is who is authorizing the agent. The party authorizing the agent could be the most critical factor in deciding whether the transaction is considered routed or not. If you don't know who authorized the agent, it is definitely going to be important to determine that and make sure that it has been done correctly. And there are ways to do that that can help you out. You also want to match your actions to fit your intentions. The regs don't care about your intentions or who you thought was responsible. It's going to be the documentation that tells the story. And you want to be explicit. If you are selling something for export and you want your customer to have the responsibility of authorizing the agent and filing the EEI, put that into your sales terms and conditions. Make sure that that's understood mutually between you and your customer through emails and other communications. But you want to make sure that you are explaining the intentions. You can say words like, we are not the authorized agent. We are not going to be authorizing an agent for this export. We are the USPPI, but it's your responsibility to authorize an agent and cause the goods to be exported. Some questions that we've hit on these areas. Documentation-wise, in routed transactions, what is the USPPI's documentation responsibility when the forwarder identifies an overage or shortage, or when the customer decides to split the shipment? Is the USPPI responsible for providing amended documents? In a routed transaction, it is not a requirement for the USPPI to provide amended documents, either on a commercial invoice or on a packing list or on a bill of lading or anything like that. Because it's a routed transaction, the USPPI is only responsible for those 12 data elements that we looked at before, which is 30.3E, where it defines exactly what they need to provide. And none of that information is relevant to the circumstances of the actual exportation. That has to do with the disposition of the goods that were provided and the condition that they were provided to the freight forwarder or to the authorized agent. So you would not have to amend your documents to reflect things like shortages or overages when the customer decides to split the shipment. Records. In routed transactions, what kind of documentation would serve as evidence to the shipper that the correct EEI filings have been completed for export compliance purposes? This is similar to one of the questions that I see in the chat here. Basically, what sort of record is the USPPI responsible for in a routed transaction? The most important records is evidence of what you provided, those 12 data elements, what you provided to that authorized agent for them to file. So keeping your records on what you said regarding the goods. And then as far as verifying what actions the agent took or whether the agent's filing is accurate, you are only responsible for the information that you provided if the agent filed incorrect information or information that is incongruous with what you provided. They're going to have a responsibility for that to census. So in ACE, you can pull a report of your AES filings, your EEIs, and you can identify certain information on there. And if you identify that some of that information is incorrect, you should notify the filer that, hey, I told you back on this date that the information was X, Y, and Z, and I see that you filed A, B, and C as that information, and that's incorrect. Please amend your filings. Those records of those communications of what you provided, that's your defense in case census ever inquires, and it would protect you from penalty for incorrect filings in a routed transaction scenario. Okay, there are a lot of questions, so I'll come back to a lot of these at the very end here, and I'm going to try and move quickly through the next section here. Maintaining compliance, penalty risk, compliance practices, references. We're going to be focusing on kind of what you can have in place, where your risks are. Again, exporting is a privilege, but there are penalties for non-compliance. You can receive a penalty you can avoid penalties if you can ensure the following happens. The EEI gets filed. The EEI gets filed on time. The EEI gets filed accurately, and you've maintained your records for 5 years from the date of export. That's the best way to protect yourself from risk. The penalties for failure to file is $10,000 plus involved property may be subject to forfeiture. Failure to file occurs when the government discovers that no AES record is on file after the prescribed time period, or 10 calendar days past the time period, regardless of who found the error. So either the government found it, found that there was no filing, or you found it, but it's been more than 10 days afterwards. You can get penalized for late filing, which is if you file the EEI after the prescribed time period, which go back to the 1 hour before arrival at the border for truck and rail, 2 hours before the airplane leaving, or 24 hours before getting on the vessel. If the filing happens after that time period, you have up to $1,100 per day, not to exceed $10,000, because then it becomes a failure to file penalty, and involved property may be subject to forfeiture. And if you file false or misleading information, or for the furtherance of any illegal activity or any other violation, you have $10,000 per violation, in addition to any other penalty imposed by law, plus forfeiture. Criminal penalties, again, failure to file, knowingly failing to file info in the AES has $10,000 plus 5 years, up to 5 years in prison, or both, per violation. Knowingly filing or submitting directly or indirectly false or misleading info through the AES, $10,000 plus up to 5 years in prison, or both, per violation. You can meet this threshold by giving your forwarder information that they're going to file, and knowing that the information is incorrect, you can be held criminally liable. Oops. And then furtherance of any illegal activity, knowingly reporting or using the AES for such purposes, $10,000 plus up to 5 years in prison, or both. So what do you do? It's important to establish and maintain an export compliance program. That includes things like policies and procedures. A good place to start with that is the Export Management and Compliance Program and Manual, the EMCP, that is published by the Bureau of Industry and Security. You can obtain that, and I believe there will be a download of that provided as part of the materials from this webinar. Communication. It is important to have conversations with your stakeholders internally. What I'm talking about, your salespeople, informing them of what your responsibilities are in export transactions, and recognizing or defining whether you're trying to have a routed or non-routed transaction, helping them understand how to communicate with their suppliers, with the customers, sorry. Talk to your shipping departments, with your compliance teams and your management team. Make them aware of what the obligations are and how they can participate in making sure that their transactions are compliant. Work with your external stakeholders, including your customers, particularly your customers, since they're going to be the FPPI in these transactions. And if they're going to be routed transactions, they have responsibilities. They don't know our regulations as well as we're supposed to. So we should be communicating what their responsibilities are to them, or helping them with that, so that we don't have a non-compliant situation. And also working with your forwarders and theirs, your own brokers and distributors where needed. And lastly, implement an audit program. So the filings that are performed on your behalf, either by your authorized agent or by the FPPI's agent, are obtainable in ACE, the Automated Commercial Environment. So you can actually pull reports on what export transactions and activity have occurred under your USPPI record. You should be documenting your accountability chain and processes, so that everything goes through the proper system of checks and balances. And you should review your records regularly, maintaining your records for at least 5 years. Key takeaways: exporting is a privilege, not a right. You must be able to demonstrate compliance. Those are important standards to maintain within your business practices in order to mitigate and minimize your risk. References and resources. Title 15 of CFR is going to be the authoritative source for information on the foreign trade regulations, and I highly recommend understanding the rules within that universe. But there are also additional resources published by Census, by Customs, and by BIS, and we'll provide these links so you'll be able to access these after the session. Some questions that we've frequently seen. How do we start being compliant? We have many different types of export transactions, and I don't know how to begin establishing my compliance program. My best advice in that universe is start with finding your role and following the FTR responsibility, the foreign trade regulation responsibilities that are associated with that role. So if it's a routed transaction, know about those 12 data elements and what you're supposed to provide and who you're supposed to provide it to. Know about how to not authorize the agents when it's a routed transaction. And if it's non-routed transactions, familiarize yourself with the 48 data elements and what information is available to you as the manufacturer or the shipper, what information is going to be provided by the forwarder, and get a good pattern rolling by having communication with your forwarders, with your agents, having communication with your customers, making sure that everybody knows what their job is. That's where I would start. Complex exports. We often sell to companies in the US who will then sell overseas, but we're not involved in the export transaction and we ship domestically. Do we have export obligations? The answer to that question is yes, you do have export responsibilities, particularly under EAR, ITAR, and OFAC, but maybe not under the foreign trade regulations. The circumstances of the shipments can matter, whether or not you're going to be involved as a US PPI in the transactions or not, in your role, the role of the distributor that you're shipping to. You definitely have responsibilities under the EAR, ITAR, and OFAC, out of the scope for this webinar, but you may or may not under the foreign trade regulations. So it's important to understand the parameters of the shipment and what's actually happening with the goods. Hopefully this provides you some good information as a starting point, and we are going to be segueing into the Stump the Speaker section as I stop the recording.